This is now probably going to be one of the big narratives going into the end of the year, because there's been a lot of speculation, obviously, about Japan and whether it would intervene in order to support the yen. The issue, I think, right now is that I think it's widely accepted, and the Japanese have probably taken this on board, that unilateral intervention here is very unlikely to work. And so all you're doing, if you are a monetary authority in, say, somewhere like Japan, and you try and support your currency, you might just be offering better levels for investors to actually go in and take the other side of that particular trade. So it doesn't look as if there's a lot of firepower behind what an individual central bank can do in this type of environment. Now, of course, this opens up the potential for what would be an extremely important market narrative, which hasn't really been spoken about that much. And that would be something like coordinated intervention, not just a central bank intervening, but actually coordinated intervention by central banks globally. And that might be a narrative to follow as we go through the balance of this year. With respect to your comments on yield curve control, the issue that the Japanese now have is we are, again, starting to see inflation in Japan. Now, of course, this is a story that's been ongoing for decades in terms of trying to remove the deflationary pillar from the Japanese economy, but actually the weakness of the yen is adding to other price pressures that are developing in Japan. So there will be pressures there for yield curve control to be removed, simply because inflation is now putting pressure in terms of the upside of Japanese yields as well. So the Japan story has suddenly become a very interesting one over the course of recent weeks, and will probably continue to be so into the fourth quarter.
And another outlier, of course, has been China. We saw the PBOC standing pat on the loan prime rate earlier this week in what has been read as defending the yuan amid this broad dollar strength and, of course, worries about that widening yield differential. Can you give us a line on China and how you're looking at that market right now, given the PBOC certainly hitting the pause button on its monetary easing efforts right now?
Yeah, we need to be very careful about one thing with China, because a lot is spoken about the weakness of the CNY. But in actual fact, when you look at the CNY relative to other regional currencies, look at it against the basket, actually China has held up relatively well. So it's a very stable currency relative to the basket. What's moved is everything bilaterally against the dollar. So Asian currencies and emerging market currencies in general, including the CNY, are all weaker, or generally weaker, against the dollar, simply because of dollar strength. But the CNY itself is actually stable against the basket. And ultimately, the authorities in China are going to be monitoring the CNY versus that CFETS basket, versus the trade-weighted basket. The fact that that's been stable suggests that they're not going to hit the panic button yet when it comes to currency. The slowdown implications in China, what that means for capital flows into and, of course, out of China, that is something that they're going to be a lot more sensitive to. But the currency, they're happy because it's stable versus the basket.